I'm gonna be talking about, are you leveraging your account to grow or are you leveraging your account to maintain? I feel like those two aspects alone is very important. I feel like a lot of people miss out on those. And that's why, some people are doing the same lot sizes that they were doing like last year. You know what I'm saying? So that doesn't make sense. And if anybody is in Wall Street Academy or has seen other lives that I've said, if your lot size is the same from last year and it is this year, what's going on? If you have the same lot size from last year and you're still doing the same lot size this year, what's going on? Tell me. Are you growing if you're doing the same lot size back-to-back years? You want to compound? So I don't really believe in the whole compound thing personally. I feel like it's a dope concept, but not a lot of people can actually achieve that because everybody preaches compound your account, but if you're not fucking consistent, then you're not gonna make the money to compound. You know what I'm saying? It's not gonna work. So this is how I see. This is how I actually been able to actually grow my lot sizes over time, and even like every now and then now, like this past week, I've done a 5 lot on US 30 twice. I've done 2 5 lots on US 30 once. But I'm stepping into that other bracket, that other comfort zone into upping my lot size. You know what I'm saying? And it was scary. You know what I'm saying? But at the same time, like if I understand like my risk to reward, that risk is one thing, but at the same time, the reward is going to be a main goal that I'm actually trying to get out of that entire trade. And no matter what your account size is, you still have to be able to understand what lot size that you should be using on your certain accounts. But all that's based on your level of knowledge, your level of skill, like how savvy are you with the charts? You know what I'm saying? So it's like whenever people ask me, hey, like what lot size should I be using in my account is this? That should not be your first question. You know what I'm saying? The first question should be, how good am I to be able to use a certain lot size with a certain size account? You get me? So it's like this. So who are my US 30 people here? Like who trades US 30 and who still trade currencies? Because me personally, I haven't traded Forex all year. I haven't touched Forex all year. I haven't traded anything dealing with Forex all year. Remember, people that have common sense, Forex means foreign exchange, meaning that I have never touched currencies all year. I've only been on US 30 all year. Only on US 30 all year. So if you are a currency trader type currency, if you're a US 30 trader type US 30, I'm trying to see like what's the network of people that I have in here like right now. You know what I'm saying? Are you 30 or alright, put 30 or FX. 30 for US 30 and FX for currencies. I want to see. US 30, US 30. Okay, US 30, FX. Okay, this is overall indexes. I tried US 30 and I didn't get it. So I'm going to tell you guys. Hold on, let me put on this thing real quick. Hold on. I'm going to tell you guys how to actually be able to scale up your knowledge to even be able to trade US 30, right? I try to be so upfront with everybody on here because at the same time, like, it's only right. Okay, hold on. All right, so can you hear me? Okay, good. All right, so it's like this. People that are brand new to trading, right? People that are like brand new to trading, right? This is how I got, and those that are note takers, definitely take out your notepad, get a pen. Because I'm trying to give you the breakdown as to like how I came into trading US 30, and like what it took to trade US 30. All right, so if you have your pens ready and your notepad ready, type I'm ready. Type I'm ready. Because I'm going to give you the entire breakdown as to like what you have to do to actually build up your skill enough to be able to trade US 30 like how I trade US 30 like every day. All right. Say type I'm ready, so I could actually give you guys a full breakdown. Take out your notepads, that kind of shit. Because at the same time, you know, you got to make sure that you're catching everything that I'm actually going over. I'm not too sure if I'm going to save it live or not. Put it to my IGTV. Okay. So people. All right. So the biggest thing is this. It doesn't matter if you've been trading since 2014 or 2015 or 2016, that kind of stuff. The time that you've been trading does not matter. Why? Because you could have been studying the wrong shit for the past 4 or 5 years. You get it? So a person saying that they've been trading 4 or 5 years or so, that means nothing. That means zip. Why? Because you could have been studying the wrong thing for 4 or 5 years. Okay? So that's like one way on how you can actually analyze where you are as far as knowledge and skill wise. Because if you've been studying the wrong thing for 4 to 5 years, then you're technically still an amateur. You get me? So a person saying that, oh, I've been trading for so and so years, that's irrelevant because you could have been studying the wrong shit for 4 or 5 years. It means zip. Okay? So if you've been studying and actually making progress as far as like with your level of anticipation and that kind of stuff for the 4 or 5 years and seeing growth in your level of drawdown and that kind of stuff, that's different because that shows growth in your skill. Okay? So now, when you first start trading, right, I feel like it's very important that you got to understand these key aspects of things, all right? So make sure that you're taking notes also because this is going to be very, very important so you can actually understand what it takes to reach the level of competence like that I've actually achieved over the past years, okay? So these are all the key things that I feel like you have to be super, super sufficient at, okay? Key things. All right, so the first thing, you have to be sufficient at your candlestick analysis, okay? That's one thing. What I mean by that is this. You have to be sufficient enough at candlestick analysis because when you're on the charts, you don't know what kind of candlestick that you're going to get, but you have to be able to analyze it so you could actually understand what that candlestick is telling you, what it means, what it's actually giving you hints to actually what's to come, all of that stuff. So you have to be able to understand each and every part of that candlestick. What a long wick means, like what a short wick means, like what a small body means, what a big body means, like where is there momentum inside that candle still? Like you got to be able to be sufficient at all of those things just for that one aspect. And this is just the first part. This is just the first part. So you have to be sufficient at your candlestick analysis to be able to hop in the market at any time and understand where you are inside the market and understand what the market is actually showing you and what is to be expected based off of what is actually being shown at that point in time, right? That's just like one aspect of this entire list that I'm going to be talking about, okay? So you have to understand I call it candlestick anatomy. You have to be able to understand every little part of it, okay? So it doesn't matter what time of day that you get inside the charts, you could actually be sufficient enough to analyze where the market is actually at that point in time, all right? So there's no perfect time to analyze. There's no wrong time to analyze. But once you get on it, you are pretty much catching up with where the market is, and you're able to actually follow through with, you know, where you are, and you could just catch up, okay? So there's never a wrong time to analyze. There's never a right time to analyze. All that matters is that you're analyzing, and then you're catching up based off of what is currently being shown, okay? That was the first thing, okay? The second thing, you have to be able to understand your, let's say, pattern recognition, right? This is just number 2. Pattern recognition means that I don't like to, you know, go too much in names and whatnot, right? But you got to pretty much understand, like, when you have 2 types of candles, right? That equals a pattern a lot of times. Those patterns can give you a lot of details as far as is there more volume in one side of the market? Is there less volume? Is this going to be a start of a counter trend? Is going to be the start of a main trend? Is going to be the ending of a trend? All of those things matter, but at the same time, you have to be able to understand each and every pattern. If it's just a major pattern, which could be considered as a head and shoulder pattern, a ascending triangle, descending triangle, a symmetrical triangle, all those stuff are just patterns that form in the overall market itself that has to be understood if it actually does come about. So it's not as if every single time you get on the chart, you're looking for a pattern, because it's not always the case. But if it does come about, you got to be able to actually be able to understand it and be able to base what is possible based off of that pattern being a part of your analysis. Okay. Next thing is time frame correlation. So time frame correlation. Time frame correlation is another aspect of everything that you have to be sufficient at. Remember, all these things that I'm listing is just to make you understand all these aspects that I'm sufficient in, right? Meaning that I could trade US30 at any time of day and pretty much analyze at any time of day to actually understand where I am and be able to fucking make money and be able to make the money that I want to make. Because if you're not sufficient at all these things, you're not going to be that trader that you think that you're going to be. I'm just being real. You know what I'm saying? If any of these things that I'm listing, remember, and those people that are late, number one, I have put was your candlestick analysis. Number two, your pattern recognition. Number three, we're on like right now, which is time frame correlation. You have to be sufficient at all these things. And if any one of these things is lacking, you got to pretty much be able to recognize that. Okay? And if any of these are off, you're not going to be able to be as savvy as you think that you're going to be inside the markets. Okay? Okay, so time frame correlation is this. Time frame correlation is super important because you got to be able to understand that you have what? The 1 minute time frame. You have the 5 minute time frame. You have the 15-minute time frame. You have the 30-minute time frame. You have the hour time frame. You have the 4-hour time frame. You have, if you're on TradingView, you have the 2-hour time frame, 3-hour time frame, 4-hour time frame, 5-hour time frame. You have the daily time frame. You have the weekly time frame. You have the monthly time frame. And some people say, which time frame is the best to analyze? Honestly, it's never just one time frame to analyze. You have to be able to understand that every single time that you're inside the markets is going to be different. Every single time that you're inside the markets, you're going to be able to have to analyze on a different time frame to understand certain areas of the market. All right, certain times the markets are going to be super tight, which means that you got to analyze on a smaller time frame so you can pretty much see a lot more data. There are certain times that the markets are too choppy on lower time frames, so you got to be able to zoom out a little bit to see things clearer. You know what I'm saying? So you got to pretty much be able to understand what time frame needs to be used at certain times to be to have the full understanding as to what to come or what is to come or what to anticipate or what to base your projections off of based off of that time frame that you're currently analyzing on. Okay? So time frame correlation is just being able to understand each and every time frame for what it is and understanding what time frame has to be used in certain situations based off of certain pairs, because every single pair is going to be different to analyze. All right? I don't analyze US30 like how I used to analyze AU or UJ or gold. You know what I'm saying? So you have to understand what time frames has to be used in certain areas to have the best analysis for where you currently are at that point in time. Okay? And a lot of this information is going to go over a lot of people's head. But like I said, I make money like how I make money because I'm sufficient at all these things. Those that think otherwise on how you want to analyze, like I said, show me better. You know what I'm saying? Show me better. That's what it comes down to. Remember, when it comes down to trading, guys, results. If you're not producing results, you're not that good like how you claim. That's what it comes down to. You know what I'm saying? Results. And no matter if you only have a $500 account, results. $5,000 account, results. $10,000 account, results. $100,000 account, results. If you're not producing results off of no matter what account that you have, you're not that good as you expect that you are. And that's fine. You know what I'm saying? Because at the end of the day, you have to be as good as you think that you are, but at the same time, you have to be able to show that you're good. You know what I'm saying? You can't be good and fucking losing every single trade. You know what I'm saying? You can't say that you're good and not level up every other month or like level up a couple times a year. You know what I'm saying? Lot size wise, lifestyle wise, something, you know what I'm saying? Something has to be leveled up. So claim that you're good, but show that you're good. You know what I'm saying? So somebody said 5 minute, 15-minute, hour daily. Wrong. It doesn't, never ever. This is a big thing. Never ever be so choosy on only trading on certain time frames. Oh, I only use 5 minute. Oh, I only use 15. I only use so. You fucked up. You fucked up because you're not going to be able to analyze as let's say as smooth as you would want to in any other market environment. You know what I'm saying? And I never ever marry one time frame because there's certain time frames that I have to be on M5. There's certain time frames I have to be on M1 for a certain amount of time to analyze certain things before I analyze, the bigger time frame at times. Like it all depends. So it's like never ever be so stuck on not using one time frame for certain reasons. You know what I'm saying? You got to be able to understand that each and every time frame means something. And I give this example in the 5-day course. All right, I was like this. Milliseconds, and this is in real life, right? Milliseconds mean something, all right? Seconds mean something. Minutes mean something. Hours mean something. Days mean something. Months mean, like, you got to pretty much understand that, like, the same way on how we treat every little millisecond in our life important, the same way how it is on charts. You know what I'm saying? We're not going to miss out on any single second or neglect any way of analyzing time because of favoritism. You know what I'm saying? So don't have favoritism when it comes to analyzing, your time frame correlation. Like you can't have favorites. You know what I'm saying? Use what needs to be used to analyze a certain area on the chart. You feel me? That's what it comes down to. So use what needs to be used. Don't be picky. Don't say I only use so and so. Nah, fuck that. That's why you're not where you want to be. You're being too picky. You know what I'm saying? Use what needs to be used to analyze a certain area. Once you're neglecting that tool that could obviously help you, but you're neglecting for a certain reason, then you're just not going to be able to catch that move, or you're just not going to be able to catch a certain kind of flow of the market at times. You know what I'm saying? That's what it comes down to. And the people that are those picky ones, they're the ones that miss out. They're the ones that don't see that growth in their lot size and that kind of stuff. You know what I'm saying? So just be that person that is a bit more open to what's in front of you and choosing the tool that can best analyze that certain area, and you're not choosing favorites. You know what I'm saying? All time frames are equal. All time frames are equal. All right. Next thing I will say, market structure. Market structure is like one other thing that you have to be sufficient at, because you have to be able to understand the overall concepts of the flow of the market. You know what I'm saying? And remember, this is no less important than any other thing that we did, or no more important than any other thing that we actually already spoke about, which was the first one, candlestick analysis, second one, pattern recognition, third one, time frame correlation, and the fourth one now, market structure. You have to be able to understand the flow of the overall market itself, to understand when a starting of a trend is, when the ending of a trend is, when the continuation of a trend is. You got to be able to understand all these things. You know what I'm saying? And like I said, like once you're not as sufficient at one of these things, like how you are at other one, then you're going to be on balance. You know what I'm saying? Then you're not going to be able to catch certain moves and that kind of shit. And somebody asked about wicks. Wicks is a part of candlestick analysis. Wicks and gaps is a part of just experience inside of markets and that kind of stuff. But wicks is a part of candlestick analysis. So that goes along with the first part. You know what I'm saying? So like I said, you have to be able to understand all these things. I mean, all of this I speak about in Wall Street Academy. You know what I'm saying? And a lot of Wall Street Academy students are on here like right now. And they're talking about it. Yeah, so exhaustion zones and whatnot, you have to be able to understand what each and every candle is actually telling you and whatnot, but also the overall picture, like I was talking about, is structure. You have to be able to understand where the structure plays a part in where you currently are in your analysis, because that's going to help you with your projections, your overall projections, when the starting of a trend is, the ending of a trend is, the continuation of a trend is. All those stuff is going to be in your market structure. The next thing is understanding, where to place your stop loss at times, because some people would place their stop loss based off of being cheap, just being cheap. What I mean by that is you can't have, like, let's say you have $1,000 account, right? And you're placing the stop loss based off like, oh, I'm only trying to risk so and so because, you know, this and that, this and that, this and that, this and that. All right. But in reality, like, they're putting it at times incorrectly, because if you put a stop loss area in an area of fluctuation, it's going to get hit. You know what I'm saying? It's no doubt about it, it's going to get hit. Why? Because it's in an area that has a high chance of retracements and that kind of stuff versus an area that has an area that is out of the range of where you currently are. And that's also plays a part of structure as well. So knowing where you are in structure, knowing where that stop loss can be placed based off of where you are in structure, and knowing that if it actually reaches a certain point that it goes beyond structure and whatnot, it's actually going to be an invalid trade. And then from there, it's going to be open to hitting your stop loss, which is fine because you're trying to, you know, keep that trade safe or keep your account safe. So the stop loss itself has to be placed in a certain area that makes sense, and not an area that you just wanted to place because you're trying to be cheap. You know what I'm saying? So once a person is actually, you know, scared that they're going to lose a whole bunch of money or whatnot, then just drop your lot size. You know what I'm saying? Just be smart about it. Like, don't try to, you know, open too much risk for yourself that you're scared to get your stop loss hit, you know? Another thing is understanding your risk to rewards. You know, there are certain times that, stop loss, risk to reward. Understanding your risk to reward. So now we're on 1, 2, 3, 4, 5, 6. So the first one, candlestick analysis. Second one, pattern recognition. Third one, time frame correlation. Fourth one, market structure. Fifth one, understanding where to place your stop loss, but that can easily be placed incorrectly. Sixth one, your risk to reward. That's very important because there's certain times that, like, I think like about a week and a half ago or so, like, I lost like 3 trades in a row, right? I remember, like, whenever I'm doing my US 30 trades, I'm at times on standards and whatnot. So like, I lost 10,000 here, 10,000 here, 10,000 here. That's what, $30,000 lost in one day, right? So then my fourth trade for that day, I made about, I know you're good. The fourth trade, right? The fourth trade, I lost back to back, right? The fourth trade, I made like 38,000, right? So which means that my overall net for the day was still 8,000, but I mean, I lost like back to back trades. But at the same time, it's just I made sure that my risk to reward was good enough to know that on one trade I could actually make up back to back losses. You feel me? So losing itself is a part of the game, but you have to make sure that your risk to reward is smooth enough to be made up by future wins. You know what I'm saying? So kind of like just understanding that don't try to put too much risk on yourself that it can't be made up in one trade. You get me? What else? 1, 2, 3, 4, 5, 6. I think the last one is gonna be let's say understanding that, make this a good one. The last one is going to be, I got it. Understanding where you are in your journey. You know what I'm saying? Like, I feel like one thing that people mess up on a lot is also following a lot of people, you know, how hard they're going on their account on IG and that kind of stuff, right? Understanding that if you only have, like, all right, earlier today, right, somebody asked me, how do you handle a 5K loss? I'm like, bro, I'm not stressing a 5K loss if I'm making so-and-so in one trade. You know what I'm saying? It doesn't make sense. It's like saying you have to pretty much understand that my losses and your losses could be literally at the same percentage overall, right? Which means that if you have $1,000 account, right? With me on $1,000 account, knowing my knowledge, a lot of times, each and every trade, I'm willing to lose like $150 or $200, right? That's me, okay? So if you know that you're brand new into your journey and whatnot, right? I wouldn't be risking that much. Like each and every trade on $1,000 account, if you're just getting started, and you're not really too confident about your your how often you're in drawdown, how much you get in drawdown and whatnot, then I would only risk a certain amount. It could be $100, it could be $50, it could be $75, that kind of thing, right? It's like saying, understand that based off of where your account balance is, understand how much you're willing to lose each and every trade, and then go based off of that. Understand how often you are in drawdown, how often are you in bad drawdown, how much are you in drawdown versus being in profit, understanding all those things. So you're risking, yeah. And I said this the other day, if you're not willing to at times risk 5%, 10%, 15% at times, like you're not trying to make money. And like me and my boy Ryan talks about it all the time. Like I told him, like, bro, like on average each and every trade, like you know, I'll be open to like around, you know, 7%, 10% risk at times, because, you know, I'm willing to fucking make money. But I also know that my skill has me in the more positive route than this negative route. You know what I'm saying? So like I said, I could have 2 losses and then have 1 win that makes up, you know, that losses plus a lot more fucking money. You know what I'm saying? So just understand where you are. Don't try to pretty much, you know, put yourself at too much risk. Understand that if you are on average seeing, on currency wise now, seeing, let's say 30, 40, 50 pip drawdown, then you can't up your lot size as fast as you want to. You know what I'm saying? So the main goal is to upping your lot size is to, you know, try to become more precise. Try to become more open to understanding, you know, how you could actually get in profit faster and not be in drawdown the entire time. Understanding how you could be a bit more accurate with understanding when the move is pretty much about a push in your direction versus entering a market that's in consolidation. Understanding all those things could decrease your amount of drawdown that you're normally in, so you could actually, you know, have the opportunity to even up your lot size. And if you're not upping your lot size, you know, after growing, if you're not trying to even up your lot size or even attempt to up your lot size at times, then you're not going to be able to be open to that new lot size or be open to the comfortability of the precision that new lot size even takes. Okay, because every single time that I up my lot size, it takes a lot more of a precision type of thing and accuracy that it takes to pretty much be able to trade that certain lot size, because I know that I don't want to fucking lose on this new lot size. So a lot of times, like if you plan on upping your lot size, just understand that you have to be a bit more precise than you were with your lower lot size, because you're going to be losing more now. So all that matters is that you're going to be working on when exactly you should be getting into the market, so you could actually get more precise with your entries, and working where that stop loss should be placed to actually get a better risk to reward. Because at the end of the day, like once you're actually getting a good risk to reward, you're pretty much solid, and the lot size doesn't really matter too much. So like once your lot size is pretty much at, let's say on a $1,000 account, you're trading UJ, you're risking on UJ, a lot of times I was risking like around 20 pips or 25 pips, so that's 250. But once your risk to reward is pretty much solid, that lot size doesn't really matter too much, because you have a high chance of that trade winning than that trade losing. You get me? So once your entry is perfect, the lot size matters only so much. You get me? So once you actually become consistent with that new lot size, then you'll become a lot more precise as well. So like you got to keep on with that trend over and over and over again. So like once you become more precise, that's when you could actually be able to actually up your lot size than it was the previous month, the previous year. As long as that is being done, that's showing some kind of growth. You get me? So that's what it comes down to. So like just being able to be open to, I wouldn't say be open to more risk, but be open to becoming more precise with your entries and trying to see less drawdown, because the less drawdown that you're seeing, the more opportunity that you're going to be having to up your lot size. Okay? That was a long time. Yeah, that was so long ago. Like UJ was like back in 2016. But I can't remember last time I was on $1,000. Yeah. Hey, some people now is brand new and they're on $1,000 account now, but at the same time, you know, everybody's at their own pace. So just be comfortable with where you are with your account size and in your journey, then you should be good. But at the same time, like I said, you have to be sufficient at all these things, which I'll say it one more time. The first one, you have to be sufficient at candlestick analysis. Number 2, pattern recognition. Number 3, time frame correlation. Number 4, market structure. Number 5, placing your stop loss in the correct area. Number 6, actually, risk to reward. Understanding that the risk to reward is super important because you have to be risking a decent amount, but also projecting, let's say, 3, 4, 5 times that amount of risk. So which means that if you do lose back-to-back trades, you could have one trade that makes up all of those losses that you took in the previous. It could have been the previous day. It could have been the previous couple hours, something. You know what I'm saying? So at the end of the day, like, it does take a lot of time and experience, but at the same time, like, as long as you're willing to, walk that path to get better and to go down that path of failure and success and that kind of shit, then you're going to be on a positive at the end of the day. You know what I'm saying? So that's what I wanted to come on here and say. Thanks everybody for coming on. We had like about 1,600 people on this live. So those are all those things. And the biggest thing that I wrote here also, I said, if you're not consistent with the lot size that you're currently at, then you cannot up your lot size. You know what I'm saying? So until you are consistent with the lot size that you're currently using, it could have been a 0.01, whatever. You cannot up your lot size until you are consistent with the current lots that you're doing. So don't think about the money. Think about the points that you're actually profiting off of each and every move. The money will come. The money will definitely come. All that takes is just a little increase in lot size, boop, and all of a sudden you got a raise. You know what I'm saying? So that's what it comes down to, and that's what I just want to come on here and to speak about real quick. Thanks everybody for coming on. You know what I'm saying?